Good afternoon, ladies and gentlemen. Thank
Hello.
you for joining us. And without further ado, let's get a brief introduction from the panelists. Katherine, would you like to introduce yourself?
Hello, everyone. My name is Katherine. I'm the head of brand communications at Liquid. Liquid is a crypto exchange. We have an office here in Singapore. We're headquartered and licensed in Japan by the Japan FSA, and we serve global markets in trading of digital currency assets.
Hi, everyone. I'm Daren Frankel. I am a director at ConsenSys, based here in Singapore. ConsenSys is a diversified blockchain company doing everything from incubation, venture capital, custom solution development, working primarily with the Ethereum network.
Hi, everyone. It's Josh Kroeker. I'm based out of Hong Kong, and I'm HSBC's global lead for blockchain activities related to trade. So I'm out there working with industry and collaborating to build digital infrastructure for international trade.
Good afternoon. My name is Boon from Deutsche Bank. I'm a unit that actually looks at the intersection of technology, laws and regulations, and what it means for financial services and the business models. Thank you.
And we should start off with the introduction of blockchain has disrupted the verticals in the financial industry. And maybe, Boon, you would like to share with us an overview?
Thank you very much, Janet. So I'll provide an overview before turning over to my fellow panelists, whom I think they'll be doing the verticals. So from a blockchain perspective, we have seen the evolution as a payment cross-border transfer mechanism for low value, very fast. So instead of waiting for 2 days or 3 days, you get it within 10 minutes. But that's like about 5 years ago now, right? So as a transfer value then, it has then morphed into trade finance, whereby it's being used currently very successfully as a store of record. For example, in title transfer document in trade finance, how do you get a digital certified true copy that you will get in paper? So with blockchain, it is possible, and this is actually pushing forward a truer digital trade transformation or cross-border paperless trade. That's really important for the region. And we see then that, from trade finance is going into capital markets, crypto to crypto, ICO to STO, from STO to digital bond, and, from digital bond to tokenized assets. In the capital markets, blockchain represents not just new efficiency and effectiveness, but also potentially new business models and new market infrastructure in time to come. So in summary, blockchain in financial services is being used across the board and with very deep potential, and we're very excited by it. Janet, back to you.
Thank you. Maybe we could talk about the different results and the new value creation in the payment space. Josh, would you like to share with us?
Well, I can talk about the trade space, because that's what I've been focusing on. So if you look at what we're trying to do in trade space, and trade being global goods and services trade, is that it's one of the last sort of areas of financial services that is heavily paper-based and process-intensive. So for a corporate who wants to start buying and selling services or goods from overseas, and they want to finance that process, it can be quite a daunting solution. So we want to make these services and these solutions to be much more accessible to corporates, both large and small, so that we can have more trade in the world. But there's no market infrastructure that allows this to happen. There's nothing that actually will bring together banks and corporates and ports and customs agencies together onto common networks. And that's where we see blockchain being really valuable, because it's not for any one party to do, it's for the network to do. And the decentralized nature of blockchain allows us to build these networks for the first time. So everything that we're doing is about collaboration. It's going to need to have a combination of public and private networks. It's going to need to have partnerships between banks, governments, tech providers to deliver this. But we're going to need to do that work on common networks. And that's really what we see happening in the space.
And Daren, have you seen the enterprise adoption of blockchain? Has that evolved over the years? Are there still people who are still very skeptical about blockchain technology because it has failed to deliver?
So I definitely come at this from a little bit of a different perspective. So I work primarily in the capital market space, blockchain applications for capital markets, and specifically with public blockchains. Just real quick crash course. If you don't know what a public versus a permissioned or private blockchain network is, a public blockchain is basically anyone can turn on their computer, they can connect to the network, and they can start transacting. They can interact with distributed applications, they can see a full copy of the ledger. Basically, they have access to the entire network, no holds bar. In contrast, a private or permission network has a restricted number of participants. You can think of it a little bit like internet versus intranet. Not 100% perfect, because if you do have a permission network, you can still connect with your peers, you can build applications. You just have to permission them in. You have to bring them onto the network, you have to give them roles, you have to govern that network. So specifically within the capital market space, and specifically with public blockchains, things have been getting really, really interesting. So many of you here are probably familiar with the concept of an ICO, launching a token. I really look at that as kind of an initial proof of concept that made huge, huge waves. I'm not going to speak to the legitimacy of an ICO as a concept, but I will speak to the legitimacy of proving use of the technology. So in the capital market space, you're able to launch a token, you're able to launch an asset that can then be traded amongst a large audience, and in many cases in a completely decentralized form, peer-to-peer. I can trade some sort of value that we agree on directly with, say, Josh to my right. We don't have to necessarily go through a trusted third party. That sort of behavior is really, really interesting in the capital market space, because you can actually deploy assets onto these public blockchains, onto these networks, and drive a lot of efficiencies both in your business, because you can reduce those transaction costs, thus opening up new classes of assets to new investors, but also really enabling a broader access to investors all over the world. You can see the entire blockchain. You can see who owns what of what asset. You can see the entire state of the market all in one place. And so what we're really working towards in capital markets is a global ledger for all things.
Katherine, would you like to talk a bit about how blockchain has changed payment systems?
Okay. So I like the phrase you used, just a global ledger for everybody. I think that on the front end side, you see a proliferation of new token projects claiming to be, the next Bitcoin, for example. So you have new projects like Libra from Facebook. You have the the Gram token by Telegram Open Network, of which we are hosting a community sale on our platform for the public sale of Gram tokens. It's really just that enablement of access to capital, really, that now these new companies, these enterprises have to be able to issue their own tokens on the blockchain, to be able to really have full control over how their participants on the network can transact with one another, and hence also resulting in cost efficiencies on their platform when you transact with their tokens. So, for example, accessing, say, services on the Libra network will give you discounts whenever you buy certain services on your platform or use certain services on your platform. I think that it is a enablement for financial inclusion. So you do have how do you say this? Sort of third world countries, developing economies that have volatile domestic currencies. They're also illiquid, so they're very strict capital controls, so it's very difficult to move money in and out. So this is where cryptocurrencies or tokens can come in and play a role to help actually move money, facilitate the flows of money in and out easily, globally, real time, low transaction costs, or almost no transaction costs, peer-to-peer transactions is the ideal picture we want to head to. But in the meantime, there's always regulations that we have to consider. So KYC, AML regulations are multi-jurisdictional. So we do need to pay attention to those. So we have to work in line with industry regulators to make sure that we facilitate funds in a safe way.
Just out of curiosity, how is that different from, say, what we have seen now in WeChat? Like we have WePay, right? You know, and that system, and how is that very different? Do we really need a cryptocurrency when we can have that kind of a payment already?
I can take this one. So I think what makes, just practically speaking, so what we can see out there and use today, I think what makes cryptocurrency particularly interesting is it's a kind of neutral intermediary for any transaction. Not an intermediary like a person, but it's an asset that no particular country, no particular government, no particular organization, ideally, has more control than any other. And so if you look at the kinds of transactions that are happening today, I mean, blockchain's first use case, you could argue, was cross-border payments. You know, Bitcoin was exchanging value all around the world. And what that really requires is, you know, a liquidity pool on either side. You know, I can exchange Singapore dollars here to get, you know, Bitcoin, Ether, Stellar, whatever it is. I can send it back home to you know, a friend to pay for some concert tickets in the U.S., and that friend can then go immediately to their local exchange and change it back. So for Singapore dollar to U.S. dollar, not particularly interesting. But if you're looking at other currencies where the correspondent banking relationships don't necessarily exist in large scale, and it's hard to move money across those borders, that model of let me buy into this kind of globally recognized asset and then send it across borders to another recipient and they go ahead and exchange it on the other side, that creates a lot of efficiency. Because then, you know, you have this single token which no matter where you are in the world, someone will take and exchange it to another currency. And so that eliminates the need to hop from one institution to one institution to one institution until finally my money appears on the other side, and who knows why I lost 12% of it on the way.
I'll just add that, you know, there are a couple of differences between WePay or, you know, the GrabPay, right, and, you know, cryptocurrency. So first of all is the ability to do autonomous micropayments. So just imagine, right, your AI needs some form of money to pay another AI. Cryptocurrency, you can do it, right? With WeChat or, you know, GrabPay, you still need somebody centralized in order to do the account transfer. And this is not an imagination thing. So in Germany, for example, the car industries are experimenting with IOTA, right? Super micro payments between machines. And I'm sure that, you know, this is actually happening in China and other places as well. So there's this possibility then that in the realm of artificial intelligence and autonomous behavior, cryptocurrency could be the new form of payments. Second point is really between open architecture and closed architecture, right? But the third one to think about is the basis of trust is different. So, you know, with GrabPay and Alipay, you are trusting the credit profile of the company. With cryptocurrency, you're trusting the robustness of the cryptography to prevent double spending. So, you know, there are some differences. But I like the one about the AI one. That's not my original, so I can say that I like it.
That's really interesting. And that has also, you know, bring me to the next question about digital assets and digital securities. Would you be able to share with us a little bit about your experience in that field?
Sure, and then after that, I'll just pass it on.
Yep.
Today, securities, for those who are investing in, let's say, shares or bonds, right, it's already electronic. You use Philips Security. At the end of the month, right, they give you a statement. But have you ever wondered, when you buy into a bond or a share, let's say an Apple share, what are you actually holding, right? Because at the end of the day, you are holding the report that your broker sends to you that says you actually own a share. And so on and so forth. For digital asset, you can say that, you know, on one hand, it's really the same because it's electronic. we would differentiate then that, with digital security, you add in the programmability part. So with traditional equity, it's still electronic, but it's a sequential basis of life cycle activity, right? So it gets issued, it gets traded, it gets there's a coupon payment, there's corporate action, it goes this way, and then the activities then come along the life cycle. With programmable or digital security, you are able to program in the life cycle up front, and therefore on the in the event of a certain, in the occurrence of a certain event, things get triggered off automatically. Dividends payment, coupon payment, that's one thing. Secondly as well, there is the possibility of building in compliance rules. Whitelisted investors who should be holding this bond, or who should be investing this equity, or if you are in country X, you shouldn't be able to invest into this bond. This can be programmed in. Again, this is already happening. So polymaths in US, right, with the compliance aware token, or maybe it's somebody else in US with such tokens. And the recent World Bank blockchain bond actually has got this built-in feature of interest payments. Although it wasn't tested out, but it was actually built in. So that's how I would see, the difference. The effect will be deep, because then what it means is that for those people who have actually been doing all these things, right, your role gets programmed into the bond. So, that's where we are excited, and going to Daren's point about capital markets, right, if this gets adopted, there is this potential to rejuvenate, or actually to add in more dynamism into a capital market.
I think it's an interesting question what you just said about if it gets adopted. And maybe it's a good question for the others as well, in terms of, you could put, I think, 100 people up onto this stage, and they'd all have some use case that they would talk about that if it get adopted, it would drive this value. But all of these assets are quite native to the networks that they're in. So what we're trying to do actually is build these sort of dominant networks, whether it's public or private. So given all the work that's been happening in banking and blockchain, where do you think those dominant networks are going to come from? Do you think it's going to be one or two public networks? Do you think it's going to take private networks to exist and be operated in an open and inclusive way? I'm just kind of curious to get your guys' views in terms of how we're going to get there, because I think there's always value if they get adopted, but that path that we're on is really interesting.
So I definitely think that there's going to be multiple types of networks. There's going to be multiple networks. It's very popular to say that it's going to be use case dependent, and I would say largely that I agree. From a permission network standpoint, that the use case will be very dependent. But I think in the permission list, the public networks, there's going to be a lot fewer networks that kind of specialize in a particular use case, and it's going to be more general purpose. And so, I think that the element of permissionlessness or permissioned, I think that both have their place. When I look at the permission world, I look at something as simple as, I'm from the States, and we had one of our largest credit agencies, Equifax, hacked in the past couple of years, and I was personally affected by that. It's amazing how the legacy infrastructure has yet to adopt cryptographic protocols in their IT stack. It's unbelievable that my social security number, the number that basically can allow anyone to open a credit card under my name, is stored basically in plain text in someone's database, that it's not secured. And so I think a lot of what I look at in the industry, especially in the private network space, is using distributed ledger protocols to enable more secure communication and storage of data, especially between discrepant independent parties. To me, the public network is still about common ledger for all things, and if you go up one more layer, it's not just about having a common ledger of who owns what, but also how those things can change hands. So rather than having, all right, I have my internal process, that other group has their internal process of how to move assets from one person to another, regardless of whether I'm trading a diamond, a car, a security of some type, we can share a common, this is what settlement looks like. These are the parties who are involved. Here's the business logic, and here's how it's executed. And so that can all be basically housed on the same system, transparent, that anyone who's participating can understand what's going on.
Yeah, I'll just add a little bit to that. What really drives the value of a cryptographic network? So it really depends on how the incentive systems are designed. So for example, the Bitcoin blockchain networks, open network, and so you have miners being incentivized in a certain way when they when they validate transactions on the blockchain. And then with Ethereum, you do have like some sort of proof of stake model, and so is the Cosmos network to encourage adoption amongst the developers and the users. So it's design game theoretical incentives is very important. How does one get incentivized while developing on the network, and also how does the network protect itself from malicious attacks? There are certain ways to design it so that, okay, it's actually discouraging to for attackers to attack the network. They'll be worse off than actually making an honest attempt to grow the network. So it's those sort of mechanisms also will drive value for the network's adoption.
Can I just ask a question? Since Josh asked, right, the panelist question, so we're going to ask him back. But really, we are actually talking about interoperability and cross-chain, right? I think Katherine was talking about Polkadot, right, and Cosmos, and then Daren and Josh was talking about many systems. So are we going to have like digital blockchain fortresses, or different exchanges without interconnection? How is it actually developing right now?
Yeah, so maybe I'll answer first, and I'd be keen to understand the other perspectives. But I think if every institution and every group of smart people come up and create their own blockchain because they think they can do it better than the last group, then nobody's going to win, and we'll just stop having blockchain conferences, and people won't show up anymore. So there needs to be, it's sort of like there was a Cambrian explosion of ideas, and now we need Darwin to take over. And we need these things to really become survival of the fittest so we can get to that scale that's going to drive value. And that's going to happen in every industry and in every use case. I think blockchain works best with dominant networks. Like if I need to explain to somebody that there's 17 different blockchain currencies and some have different encryption protocols and there's pros and cons of each one, it might be easiest to just do nothing. And I think the same thing in the stuff that I'm doing with trade is that if I have to go to a client who's an international trade, I'm like, well, if you're trading with that country, then use this network. And if you're trading this commodity, then use this network. And this counterparty in that bank's on that network. They're like, well, just forget it. I'm just going to do it the way I've always been doing it. So I think we need to move into that stage where there's a lot of smart people around the world who are working on these problems, but we have to get back to the beginning of why we're using blockchain. It was about building these peer-to-peer networks. Let's be peers, let's connect, and let's build some dominant networks to really solve the problems.
Is there anything you want to add, Katherine?
So I'd be curious, like, what percentage of traffic you see in like the top currencies versus like all the altcoins. Like, there must be an 80-20 rule in play.
Yeah, so we see Bitcoin and Ethereum pairs dominating. So it depends on the exchange offering. So for us, we see a lot of volumes for our fiat on-ramps. So because we're a fiat crypto and crypto to crypto exchange as well. A lot of other exchanges out there do just pure crypto trading pairs. Yeah, so we see predominantly a majority of volumes for us coming for the Bitcoin Japanese yen pairs. Bitcoin's really big there, and followed by Bitcoin USD. Yeah, but tracking back to interoperability, I think that is going to be an essential development for blockchain innovation going forward. We have collaboration. We can't operate in silos. So let's see some use cases. I think one of them was JPM coin. So they wanted to issue their own coin for settlements, I think. But it has to be adopted by other banks for it to work, right? So similar to other networks as well. And similar to other business models, every single token project out there that wants to do an ICO has to have buy-in from their entire community, has to have that faith that, hey, my token's going to be of value when our MVP gets launched, right? So delivering on that and actually having that participation from your community and your network is really what's going to drive value going forward.
Yeah, I didn't really answer the interoperability question because I think interoperability means you've failed at collaborating and you haven't actually agreed to work on common networks. So now we need to find something at a lesser value that we can at least share some sort of data or maybe potentially get to the point where you can actually trade a digital asset from one to another. But if you look at the corporate space and the commercial space, the barrier to interoperability is not tech. It's all of the legal and it's all of the governance that goes into joining multiple networks. So I think the fewer networks we have, the better. I think there will be dominant networks if there's a dominant network for payments. Bitcoin is not the best cryptocurrency network, but it is the most popular, and that's interesting.
Oldest.
Actually, I've heard in trade, Singapore digital trade finance, right? Thailand digital trade finance, the moment it needs to cross border, it goes to paper first before it goes to digital, right? So going to Joshua's point about laws and regulations being a very important catalyst. Yeah.
If you want to do Bitcoin, you want to do blockchain, don't build your own, join one.
Yeah. Just on this interoperability, what's really interesting from permission and permissionless, right? I think the announcement just came yesterday. Swiss Digital Exchange, which is running on R3 corridor, right, has just entered into an agreement that they will also list and trade, I think, 20 ERC20 contracts on a regulated exchange. So I guess that's another interpretation of interoperability, right? From regulated with unregulated, with different technologies being involved. That's really amazing.
So I think interoperability, so one part is definitely standards. Actually, one of my criticisms of my own community in the blockchain space is the community is very young. You've got a lot of really spectacular young technologists working on some pretty amazing things. But there's a habit of, someone publishes a paper, everyone jumps on, it's like, this must be it. This must be the standard. We know that this is perfect just the way it is. And I'm sorry, that's not how standards work. The first thing that comes out into public view, that's not necessarily the thing you adopt. It doesn't necessarily consider everything that's going on. Ultimately, standards adoption will depend on what the industry, what the users actually decide. And so it has to be kind of user-driven standards. So I think standards are key to interoperability at a large scale. From a more pure technology point of view, I think that a lot of the announcements around using one network to trade a token from another network or vice versa, in many cases will have some element of you're introducing room for error. You're introducing attack vectors, because ultimately what you're doing, you're having some party hold an asset from one network and issue an asset on another network. So that's how it's working with Swiss on Ethereum on R3, and that's how a lot of cross-chain value actually moves. You have some party who's standing in between, holding onto an asset on behalf of another network. There's a lot of research going on to actually limit that process, using a lot of really complicated cryptography. But generally speaking, if you're looking at very discrepant technologies, if you're looking at very discrepant network forms, it's very, very difficult. And so I think interoperability is definitely something that's desired, but ultimately I think that interoperability is going to take a lot longer to realize in a secure manner, and ultimately I think it might end up just being, all right, we're actually going to move most of our application logic or our tokens or whatever it is onto this small group of networks or this one network, because ultimately it's faster, cheaper, easier, more secure, lower risk, et cetera, than it is to try and connect network A to network B.
So in this space, what are the headwinds to innovations in the blockchain space? Would that be regulatory constraints, or would it be the lack of interoperability?
I think
Headwinds.
I'll keep this one short. I think a lot of the challenges to innovation in the space. You called out JPM Quoine earlier. That's a 2015 use case. You know, I'm going to come in and I'm going to launch a token contract on my internal network. Congratulations, nicely done. You're 3-4 years behind everyone else. Give it another go. So I think a lot of people are still latching on to anything that they can get. And as someone who works in blockchain full time, everything has to start with what's the actual value we're delivering. And so trying to shove a technology on something just to say that we're doing it, i.e. JPM Coin, we're using blockchain, is not the way to go. And it's still something I see time and time again. I've seen startups come and go working on the same exact use cases because they think like, oh, this is going to be the future. Well, it's not. If you had done a little bit more research, you would have seen it didn't work before. It's not going to work still. So I think that's a big hindrance.
So banks are slow. So I'm still working on 2015 use cases too. But I think that's one of the headwinds, right? Is that it's the institutions that are trying to do this. You know, the panel is called banking, blockchain. If the incumbents, the banks that are doing this, and we represent a couple of large banks, they're doing things in new ways. Banks don't really deal with leading edge technologies all that well. So we're sort of pushing the envelope and trying to say, how do we deal with something that we know the way that we're using it now is not the way we're going to use it in the future. You have to be iterative, you have to be agile, you have to really focus on the process. But I think what you're talking about as well is important, which is there needs to be a reason why you're doing it. There needs to be a big value creation at the end. But I also think one of the big headwinds is that everyone usually gets that part, but they don't get all of the steps on the way. It's sort of like climbing Everest without knowing which side to start. It's like everyone knows they want to get to the summit, but it's very important you choose your route carefully because a lot of them end off in cliffs. So I think that's what's really important. This is the headwind, is that everyone knows where they want to go, but if you don't plan that path in terms of how are you going to get there step by step, slowly sort of reaching that value, adding collaboration, adding features, adding functions, adding scale, then I think they'll fall off a cliff. So I think that's one of the headwinds that I see.
I think the time horizon is a headwind, right? So I'm going to be a bit abstract here. You know, for example, we still get comments that, hey, you know, is scalability an issue or scalability is an issue? But that's really, you know, based on experience about 3 years ago. So, you know, cryptos 3 years ago and the technology 3 years ago and cryptos now and the technology now is very, very different. Therefore, I think, you know, I would say that we need to maintain an open mind and to understand that where we are right now is at the initial stages of a very long-term development. So give it a chance, and then, you know, keep refreshing your impression of, you know, things that may not have worked yesterday, but actually could be working very well today.
Yeah, Janet, that's a very interesting question. It's got me reflecting quite a bit. Yeah, when we talk about you know, disruption of financial services, or, you know, the kind of services that fintech companies can provide to incumbents, for example, to our communities here. Speaking from the perspective of an exchange, we're in business because our customers first put us in business, right? So what we provide is really just the liquidity that the market needs, the crypto market needs, to help facilitate trades, seamless flow of funds, so that projects can get access to funding, access to capital, access to secondary markets trading in a new globalized digital economy. That being said, I would say a challenge would be, again, we would love to disrupt ourselves because exchanges are a commoditized business. There's hundreds of us out there, hundreds, not thousands. So, for example, atomic swaps, perfect example of a disruption in our space. But it just needs to be scalable for us to adopt, you know, as part of our core offering as an exchange, for example. We would love to get there one day with the right technology partners. Yeah, but at the end of the day, it's really how do we deliver value to our customers? How do we work with regulators so that, okay, we're not effectively financing terrorism. Yeah. So, for example, standardization of regulations globally is something that's being discussed right now as part of the sidelines of the G20 summit in Osaka. So you have the virtual asset operators coming together from all over the world to discuss, okay, how are we going to standardize AML, KYC measures as a global move industry. Yeah.
Thank you. And now we will open the questions. Are there any questions for our speakers? No? If not, then I will ask the last question. If you are asked, I think Katherine shared a very interesting story with me just now about someone who was paid 100% in the cryptocurrency. If today your employer were to tell you, would you accept that? And if not, why not? Katherine?
Since I brought up that question, shall we answer it first? Yes. So if my employer were to pay me 100% in crypto, I would accept it provided I can liquidate it instantly. So there's got to be a very liquid market for it. I want to be able to spend it on, say, a Visa card that accepts cryptocurrency. So, for example, I think Crypto.com has already issued their cards out here in Singapore, and you can basically charge your card with crypto and then start spending it in the real world. So I have a friend who does that. 100% receives 100% of his salary in crypto, like pays his rent with his Monaco card, pays his groceries and everything with his Visa, Monaco Visa card. And so it's perfect living, breathing, walking example of someone who's fully immersed in crypto, works in crypto, gets paid in crypto. I think it is doable today. Yeah.
I'm surprisingly a little more risk averse. Probably would not take my whole salary in crypto simply because for me, I'm looking to make my money on something I build, not on speculating the markets. But I would say if I were to take salary in crypto, definitely I agree with liquidity. Would not take it in any sort of ICO, Bitcoin token. Kids, don't do ICOs. Not good. But yeah, I think I would be willing to take cryptocurrency as salary if it were Bitcoin or an Ether or something that has high liquidity all over the world.
So I live in Hong Kong, so 90% of my salary goes to rent. So as long as my landlord will accept it, I think why not? But I think what's interesting about the headwinds too is the other thing I think would be really important is the user experience around blockchain in general is really important as well in terms of delivering the ease of a very modern digital technology. I think the last time I tried to open up a wallet and an exchange account, like it's still not all that streamlined. And I think that's going to be important as these things go mainstream. When I go and demo a blockchain solution to a client, they don't actually care how the blockchain works. They assume we take care of that. They want to know, is the button in the right place? Is it a very nice walkthrough? Is it clean? Is there all those things? So I think for it to become more common like that, to accept it as your payroll, I think you're going to work a lot on the adoption, but also on the user experiences as well. And then sure, why not?
I would just very quickly second that. I work a lot of time on trying to teach people how to use basic distributed application interfaces, and when I actually go through and teach, I realize how much background knowledge I have and how difficult it is for a new user. So it still is, even with the most sophisticated UI, most sophisticated application, a lot of the tools are still not user-friendly enough.
I've got no choice. My bank pays me in the bank transfer. Thank you.
Thank you. And with that, we will wrap up this session. Thank you, ladies and gentlemen, for your time, and a big hand to our panelists.